Hi, Fools. So there are several signs that show that the coal industry may be coming back from its depths of 2012, but that doesn't necessarily mean that everybody will equally benefit from this rebound. Just to give an example, Alliance Natural Resources Partners had a record quarter, but Alpha Natural Resources saw an EBITDA drop of about 35% year over year. And one of the biggest factors because of this, and in the entire U.S. coal industry today, is exposure to Central Appalachian coal manufacturing. What was once the longtime heart of U.S. coal production, today coal seams have been getting thinner, and the cost to extract these resources have been going higher and higher. Today, this region is at 50% of its peak production, and there is still a lot of downside risk because of these higher costs and more difficult access to coal. And it also has the most direct competition with natural gas because of its proximity to the Marcellus Shale. And one of the other reasons is because utility companies in that region have the ability to switch between natural gas and coal quite readily, meaning there can be some big problems with pricing. Just to give an example, Alpha Natural Resources CEO Kevin Crutchfield on its recent conference call said that Central Appalachian steam coal is out of the money, you could say, if natural gas prices are below $4. And in this region, which would be the New York City spot price, it's currently at $3.46, which basically means that Central Appalachian is out of the money. At the same time, increasing environmental concerns could be a big problem for Central Appalachia as well. Arch Coal lost a permit for a Central Appalachia mine in 2011 because of violations of the Clean Water Act. So something to really think about in this region. One positive it does have is it's a strong producer of metallurgical coal for steel production. But weak EU demand for metallurgical coal, and in China right now, and an increase in supply from places like Australia has meant that metallurgical coal prices are at a multi-year low, and a lot of companies are actually shutting in their metallurgical coal production in hopes of a better pricing later down the road. So what does this exposure to Central Appalachian coal affect the most? Well, obviously you have Alpha Natural Resources and Consol Energy. Both actually have somewhere between 50 and 55% of their production in the Central Appalachia region. Arch Coal has about 19%, but a majority of that is in metallurgical coal, which could become more productive if metallurgical coal prices increase. So these companies are certainly bearing the brunt of the problems because of Central Appalachia coal. By contrast, Alliance Natural Resources Partners, and Peabody Energy both have zero operations in Central Appalachia. So quarterly results for both these companies were much stronger because of that. So prices for coal could come back and improve over the rest of the year and give these Central Appalachian producers some price relief. But overall trends suggest that Central Appalachia mines, will struggle to generate returns for the foreseeable future. So I want to thank you very much for your time. Tune into Fool.com for more insight and analysis.